If not, I'll keep moving forward, but feel free to stop me. So let's say so now we've covered over the acquisition of the asset and how to depreciate that asset under 3 methodologies: the straight line, the units of production, and the double declining methods. Now we have to distinguish between revenues and capital expenditures. What do we mean by that? What is going to be on our balance sheet versus what's going to be on our income statement? An expenditure is always going to be related to a debit, right? We're going to be, because we're crediting cash or we're increasing a liability. Whether crediting liabilities or crediting cash when we have some type of expenditure. So we have to have an associated debit. The question is that debit going to hit an asset account or is it going to hit an expense account? If it's an asset account, it's going to be expensed in the future. If it's the income statement account, it's going to be expensed today. And so how do we differentiate between those two? So we have these two concepts. If something's an ordinary repair, so if it's maintenance in the normal operating condition, it does not increase the productivity or does not extend the useful life of the asset, then it is considered an expense in the day, on the day that you incur the expense. So what this means is we're not improving the asset, right? We're just keeping the asset going. It's a regular cost of maintaining the asset. So this might be like an oil change for the car, right? We're not going to be able to add to the asset's value by doing the oil change. It's just part of running the asset, running your car. But what if we put a new engine, a brand new engine in the car that helps the car live another 10 years? Well, that's really a betterment or extraordinary repair because it extends the life of the car. For a machine, what if we replace a major machining part? For a building, what if we replace the foundation? These kind of major repairs will capitalize and add to the value of the asset. So that's the main takeaway. So just make sure you understand, we generally are going to expense costs after acquisition related to the asset unless it's significant. And that significance is a judgment area, right? We might be based on a dollar value, both quantitative and qualitative information. Quantitative being a dollar value and qualitative being on, does this actually extend the useful life of an asset? Because an oil change can be argued as something that was going to extend the useful life of your car. You need to do the oil change, but the dollar value is generally pretty low and it's part of it's ordinary. We'd expect to do that. While replacing the engine for a car is pretty extraordinary and the dollar value is probably higher. So now that we've talked about all the concepts of expensing and capitalizing our assets, what happens when we sell the asset or throw it away? So we've had the car for 5 years. We've used it. We want to get a new car. We can either throw away our car or donate it, or we can sell it. What do we do? Question. Let me see. Yeah, Griselda said, yeah, you can write it off. That's a good thing. If you just throw away the car, you're pretty much writing it off. And we have to do the journal entries at that point to write it off. You're correct, Griselda.
You can sell it.
Yeah, you can sell it. That's true too. We can sell it, we can toss it, we can write it off as a tax reduction. There's a bunch of stuff we can do. And so we have to be able to account for all those different scenarios. So at the point of disposal, we need to update our depreciation methodology. So if we dispose in the middle of a year, we're going to have to do that partial year depreciation and determine how much is our depreciation. Then we're going to record the cash we received or paid and remove our accumulated depreciation. And then we're going to record a gain or loss and remove the asset cost from our books. So eventually we have to get it off of our books and determine if we have a gain or loss. So the concept's simple, right? Either like we made money from selling it or lost money based on the value on our books on that day. So our cash is greater than our book value on the time of disposal, then we get a gain. If our cash is less than the book value, we have a loss. And if it's equal, there's no gain or loss. So let's talk through these journal entries. A machine costing $9,000 with an accumulated depreciation of $9,000 on December 31st of the previous year was discarded on June 5th of the current year. The company is depreciating the equipment using a straight line method over 8 years with 0 salvage value. And so on the day one, we debit our asset, which is our accumulated depreciation. Oh, wait, sorry, machine cost. Oh, so on this day, we're throwing out a fully depreciated asset. So since on day one, we debit our depreciation of 9,000, debit our machine of 9,000 and credit our accumulated, and credit our cash. And then over time, we've depreciated that asset by debiting depreciation expense and crediting accumulated depreciation. We have $9,000 of machinery in our books and $9,000 of accumulated depreciation. On the day we throw it out, we just reverse that entry, and then it's no longer on our books, right? We'll just debit accumulated depreciation because that's a credit normal balance, and we'll credit the machinery, and it's done. We threw out the asset. But now let's say, what if we are throwing out an asset or discarding an asset that has depreciation left to accumulate? So we have equipment costing 8,000 with accumulated depreciation of 6,000 on December 31st of the previous year. So we know that it has a book value of 2,000, right? Equipment costing 8,000 minus 6,000 is 2,000 of book value. The company also, we dispose of it this year on July 1st. So we have another half year of depreciation to do. Oh, and so we're doing 1,000 a year because it's an 8-year depreciation model. And so we know it's 6,000. First, we have to do our depreciation expense of the $500, which is the 8,000 divided by 8 years, divided by times a half a year. So that's our 500. And then we add that to our accumulated depreciation. And then our accumulated depreciation less our equipment cost is our loss on disposal of equipment, that 1,500. So we need to debit our income statement immediately and have a loss of disposable equipment because we threw out our equipment before it was fully depreciated. So that's throwing out assets. We're discarding assets. What if we sell the asset? If we sell it at book. Yeah, go ahead.
And that goes on the loss or the gain goes on the income statement, right?
Correct. Losses and gains are always going to go on your income statement. Good question. Any other questions?
Thank you.
Good question. So this is where we need to understand the depreciation methods and how to calculate the depreciation, because then we need to figure out when we discard the asset if we have a gain, loss, or neither. What if we sell the plants at book value? So we're getting cash based on the book value that's left. So our equipment is worth, our equipment has a book value left over of 3,000. That 3,000 is the 16,000 minus the 12,000 minus the 1,000 of additional depreciation expense we calculate because it's a quarter year. The annual depreciation is $4,000 a year, and we're depreciating it on March 31st. We sell it for $3,000 cash. It all balances. We debit our cash, 3,000, what we're getting. We debit our accumulated depreciation, and we'll credit our equipment. So there's no gain or loss. We just write off the accumulated equipment, depreciation for the equipment. We write off the equipment, we get the cash. But what if we get more cash than the value of the asset? We'll get a gain. So in this situation, we got $7,000 of cash for the same situation. We'd have a gain of $4,000. It's the balancing entry. Cash doesn't change, accumulated depreciation doesn't change, and equipment doesn't change. What changes is the gain. That gain is $4,000 because we received $7,000 of cash when the net value was $3,000. The other ways we can calculate this, to keep it simple, you need to know the journal entries, but simple calculation. Gain and loss. We just say, what's the book value? We know what book value is, right? It's gross value minus depreciation. So we can do that. Gross value, depreciation, accumulated depreciation, right? So if we have a $20,000 asset and our accumulated depreciation is $10,000, our book value is 10,000. And then our selling price, if it's 12,000, okay. It's positive we have a gain. And then you can just change these numbers around. If it's 8,000, we have a loss, right? So all we have to know is if our selling price is less than our book value on the day of disposal. Then we get a gain or loss. It makes sense. Did we sell it for more than it's worth today on our books? Important note is that if it's worth more on our books today, it doesn't necessarily mean that it's worth more from a fair market value. Remember, accounting is different than fair market value reporting. So, which is why we can have gains and losses accordingly. Right, this equipment is worth $7,000 on this day, even though our accounting is showing $3,000. That's why we have a gain or loss. Accounting is just trying to approximate the impact using accrual-based accounting, using the matching principle. Same thing with below book value, right? Below book value, if we sell it for less cash than it's worth, then we'll take a loss. Journal entries are always the same. We have to do the true up of depreciation expense on the day of depreciation, right? So if it was on the end of the year, it would be for a full year. But if it's on March 31st, we have to determine the value on March 31st for a quarter of the year. If it's on June, for half the year. September, it's for 3/4 of the year, and so on and so forth. And then we determine how much cash we received. That's easy. We should know that cash is always a debit, right? So cash, debit, that should be an easy entry. We have to remove the accumulated depreciation, which was previously a credit. That's why we debit it now. And the equipment, since it's an asset, it's a debit, and we'll have to credit it to remove it. And the difference is going to be your loss or gain. And that should equal the calculation we have here. So lots of different ways to do this. I'm just making sure we understand it. Any questions?
So, I have a question. What is happening on the balance sheet side? Once we record the asset on the balance sheet, we're never touching it again.
Yeah, so once we dispose it, it's gone, right? So the balance sheet, good question. We have our asset less our accumulated depreciation equals our total asset, our net asset value. Right? And so if our asset is equal to $10,000 on the balance sheet, that's a debit, right? I hope we all know assets are debits, normal balances of debit. Our accumulated depreciation is a contra asset. It's a credit. So if it's $10,000, we have a net asset value of 0. So that means it's fully depreciated and it had no salvage value. So we can have a value of 0, but still be using the asset. From an accounting perspective, that's possible. And all we would do when we do the journal entry is we just credit the asset, right, to remove it from our books, remove it from books. We credit the asset. Debit. So we debit the accumulated depreciation and credit the asset. And it'll give us a 0. The net impact is still 0. It's just on our financial reporting, we show if we still have assets on our books that are fully depreciated. If this changes, right, let's say our accumulated depreciation is 8,000, we're going to have a gain or loss. So in this situation, we have a loss, right? Our book value is, our net asset value is 2,000, but we're throwing it away. And so we're going to have a loss of 2,000. If we received cash, we'd have a gain. If we received cash of 4,000, we'd have a gain. So that's kind of how we have to balance our entries. Just remember, there's 2 sides of this entry. There's the disposal of the asset, and then if we receive cash or not. Does that make sense?
Yep. Thank you.
no problem. And that's all we're doing here. This is just an example, so let me walk through it so you have a recording of it. So if a company pays $1,000 for equipment, expecting it to last for 4 years, and have a $200 salvage value. Let's do the entries. During this, prepare the journal entries. So on the purchase of the equipment, we debit the equipment of 1,000, we credit the cash for 1,000. That's just this first one. We should all know that by now. That's simple. If that's complex for you, you really need to go back and study. Second one, during the second year, $400 in cash is paid for a new component expected to increase the equipment's productivity by 20%. Since it's a betterment, right? It's a substantial asset. It's 40% of the asset's value, and it's bettering the asset. We capitalize it. So we're going to increase the equipment value by 400 and reduce our cash by 400. Debit equipment 400, credit cash. The next one, during the third year, 250 in cash is paid for normal repairs. Normal repairs we expense, right? So we're going to have a repairs expense of 250 and cash of 250. Normal repairs we expense, betterment we capitalize. And then C, equipment of 500 during the fourth year, 500 is paid for repairs that are expected to increase the useful life. So maybe we get a new engine in the car. We're going to capitalize that. So we're going to add it to our equipment. That's going to increase our depreciable base and increase how much our depreciation expenses over the life, right? So it's the different of timing of when we're recognizing these expenses. Key words there, right? If it says normal or ordinary repairs, you're going to expense it. If we're increasing the useful life or productivity, we're going to capitalize it. Second one, the company owns a machine that costs $500. What's the journal entry for the purchase? Debit the machine, 500, credit the cash, 500. Impact on accounting equation, 0, right? Asset went up, asset went down. The machine needs a bunch of repairs, and it was not worth repairing. The company disposed of the machine, receiving nothing in return. And then it says, what is the different journal entries? Let's see. Oh, sorry, the different journal entries in all these scenarios. So it needs extensive repairs, not worth repairing. When it has an accumulated depreciation of 400, we kind of did that. We're just going to write it off. Depreciation expense of 400, accumulated depreciation of 400. That's going to be this regular journal entry. And then if we throw it out, it's just going to be using this kind of calculation, right? We kind of went over a lot of examples like this, where you're just going to have to, if we receive cash of 80, we're going to have a loss based off the difference of the 500 and the 400. If we receive cash equal to it, there's no loss. The disposal, if we get no cash, we're just going to get a $100 loss. And we receive greater cash, we get a gain.
So
in all situations, we get cash or no cash. In all situations, though, we have accumulated depreciation that we write off and the machine value that we write off. And the rest we just determine. If there's cash, you debit it. And then if there's no cash, then you have a gain or loss. This next piece is a little complex. I'm not going to put it on a midterm. It's not that most of you aren't going to go into natural resource accounting. And if you do, you'll probably have to brush up on it then. But I'm just going to let you go pretty high over this. The important pieces of this lecture we've already covered. I really just want you to know straight line, double declining, and units of production, and understand the difference between acquisition costs and repair and maintenance costs, and how to do the journal entries from acquisition to disposal and sale. So once you have all of that down, that's pretty much this lecture. And the rest is just making sure you understand what could else be thrown out at you. So natural resources, there's special depreciation methodologies for natural resources, which are called depletion. So as we are extracting natural resources, we're going to have something called accumulated depletion rather than accumulated depreciation. And so we're going to determine that similar to the units of production method. We're going to determine the cost of obtaining all of those natural, like let's say we have a gold mine. And we'll determine the cost of that gold mine, reduce it by the leftover value of that gold mine, and divide it by what we expect. Maybe that gold mine has 250,000 tons of gold. And we'll expense it as we mine the gold. It's very similar to the units of production method, so I'm not going to go into it too much. Just make sure you understand there's some different terminology for natural resources. and just know that there's other complexities, but I really don't want to dive into it. Most people here are going to go into software or something. I don't expect most people to go into natural resource accounting. This is also important because there's a difference between tangible and intangible assets. This class is focused on tangible assets, but there's sometimes we buy assets that don't have a physical substance. Does anyone know some examples of intangible assets in this class?
Stocks?
Oh, stocks. I mean, stock is actually it's more of an equity investment, and not necessarily, but it is kind of, you have a right to these tangible assets. So we wouldn't necessarily call them intangible assets, but we'd call them more of an investment. But
how about a design for something? I mean, you could write it down, but the actual design is.
Yeah. No, that's good. Exactly. You're kind of on the right track there, and some other people are on good. So like software designs, or what we're really looking for is patents and trademarks, right? Like if you have a design, you could trademark it or patent it. And that is an intangible asset. It's something that it adds value. We have an ownership right over it, and it has an intrinsic value, but it doesn't physically exist, right? Well, a stock, if I own a company that owns a gold mine, I theoretically own a percentage of that gold mine. So there might be a physical correlation to the stocks, even though there is an intangible component as well. Generally, when we're talking about intangible assets, though, we're talking about trademarks and patents. So they're non-current assets without physical substance, and they often exclude rights or provide exclusive rights or privileges. So that means that I have a right to sell iPhones. I have the right to the design of iPhones. No one else can make it. That's a patent, right? Or I have a right to use the name Subway, kind of trademark the name Subway. There's a value to that. It's often difficult to determine the useful life of this. Like how long do we know the patent will provide value? And generally we acquire it for operational use, right? Generally, if it's a design, we need that design in order to sell our product. And so here's a lot of different examples: patents, copyrights, franchises and licenses, trademarks, goodwill. This goodwill concept's interesting, where like there's goodwill of if you acquire a business, then you kind of acquire all of the employees and all of the value of those employees and other intangible benefits. So if you pay over the net asset value of the business, you get goodwill. Improvements for leases, research and development costs, and other intangibles. And so whenever we're determining these intangible rights, we record them at cost, which includes the purchase price, any legal fees for transferring the asset, and any filing fees. So just know these intangible assets exist. They actually get relatively complicated in future accounting courses, but for this, I just want you to know you should be able to identify the difference between an intangible and a tangible asset. And so if we're determining the cost of an intangible asset, just like here, publisher purchases a copyright of a book for $1,000. It protects the owner for 5 years. The company plans to market and sell it for the original for 7 years. Prepare entries. So we're going to record the $1,000 of the copyright expense, right? That's what it would cost to get it. And then we're going to amortize that over the life of the patent, the 5 years. Even if we plan to sell it for 7 years, the patent really is only worth 5 years. I'm not going to throw too many of these at you. I just want you to get the concept and know the differences of classification. And so generally, you're going to pay what the cash is, and then it's not known as depreciation expense when there's an intangible asset. We're talking about accumulated amortization is the word, amortization. So if you hear the word amortization, it's just the depreciation of intangible assets. So let's talk about asset turnover ratio. We've done so many turnover ratios now. I think that I don't need to, they're just simple ratios. So I'm not going to continue to document them. If you want them for your notes, you can. But all this is we're determining how many sales we make by our average total assets. And so you can see here's 2 different beer companies. And they have very different business methodologies based on their asset turnover ratio. So you can see here, Coors this Coors company or Coors Light at the time, they have a lot more assets than their sales, which means they're not really being efficient with their asset use. While this Boston Beer Company has a relatively low amount of total assets versus their sales. And so you can see how efficient a company is being with its assets based off of the asset turnover ratio. That means how quickly they're using their assets to create cash. Higher is better. Means we have more sales per asset. The last piece I just want you to be aware of is called exchanging of assets. So we can exchange our assets instead of pay for them, right? So in theory, I could have a car and Jeremy wants a car, but then Jeremy doesn't, Jeremy has a really fancy motorcycle that I really want. And so we could trade. Jeremy's like, hey, I got injured on my motorcycle. I want a car. And I'm like, hey, I want to pretend I'm cool. I'm going to get a motorcycle. And so we could trade it off, but each of those have different values. And so at that time, we have to determine one of us is going to have a gain or loss. Maybe the car is more valuable or the motorcycle. And so there's a few things we have to consider when we're doing this trade for a business, because if we don't consider them, we can kind of commit fraud. So the idea here is, does our transaction have commercial substance? Let's say I trade something with Jeremy and there's no real purpose to it. Like, I don't really need the motorcycle. He doesn't really need the car, but I'm asking him to do it. And Jeremy said, hey, I want to take a loss on my books because I want to have less taxes. And I say, I want to gain because I want to show my shareholders my company's making more money than it is. We could theoretically make a fraudulent transaction there by, like, let's say trading the same car. I'll say, like, hey, I'm going to trade you a car. You say it's worth $1,000 less, but we both know it's very similar. If that happens, then it doesn't have commercial substance. Commercial substance means there has to be a real driven purpose for that makes business sense for us to do the trade. So that's the first threshold, right? Otherwise, we can commit fraud on the books. So if we determine it does have commercial substance, I really want the motorcycle, my business needs it, I think it'll help it, he really needs the car, then we can determine if there's a gain or loss based on the book value of the assets given and the change of cash. And so a company acquires $40,000 in new equipment. In exchange, the company pays $33,000 in cash and trades in old equipment. The old equipment has an original cost of $36,000 and accumulated depreciation of $20,000, book value of $16,000, and it has a trade-in allowance of $9,000. And so what we're going to do is, I'm not going to care about his book value, and he's not going to care about my book value. We're going to take the market value of the assessed asset. So we're going to have an appraiser assess the market value, and then we're going to determine the gain on loss based off that. So in this situation, let's say the motorcycle is worth $42,000, and I gave him $33,000 in cash and gave him my car, which was $16,000 on my books. I'm going to have a gain or loss of I'm going to have a loss of $7,000 because the market value is less than the value of the assets I gave him. So that'll be my loss. I gave him more than it was worth at the time of purchase. In exchange, he's going to have a gain, but they're not going to be equal to each other. My car is worth $42,000, but he gave me his equipment, the $16,000 in equipment, and cash of $23,000. So only gave me $39,000 worth of value. He'll have a gain of $3,000. That's only if there's commercial substance. And then this is how you do the journal entry, where you put it'd be just like having a gain or loss for other equipment, except now you are also buying new equipment. So you do all the same old entries, except we'd add in the equipment. It's very similar for a gain. And I'm not going to go into the examples here because I'm not really going to test you. I just want you to understand those concepts. Like, the more important thing is to know that we don't have to necessarily sell assets for cash. We could trade assets. And if we do trade assets, there needs to be a reason behind it. If there isn't a reason behind it, then it's fraudulently misrepresenting the books. So if you ever go do own your own business or become an entrepreneur, you don't get deceived, right? That's the main purpose of this, but just for your knowledge. That's it for this chapter. I'll make sure these recordings are up. Are there any questions?